Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. Today we'll delve into the fascinating world of real estate investment trusts, or REITs. Now, you might be wondering, what exactly is a REIT? Well, simply put, a REIT is a company that owns, operates, or finances income-generating real estate. It's a way for you, the investor, to put your money into real estate without the need to buy a property yourself. What sets REITs apart? They're unique in that they allow anyone to invest in portfolios of large-scale properties, the same way they invest in other industries, through the purchase of stock. In return, REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. So ready to discover more about REITs? Let's dive right in. Now that we know what REITs are, the question is, how do we invest in them? The process is straightforward and similar to buying other types of stocks. You can purchase shares of a REIT directly on an open exchange. All you need is a brokerage account. There are also mutual funds and exchange-traded funds, or ETFs, that specialize in REITs, providing a way to diversify your investment across multiple properties and sectors. Online platforms have made the process even easier, allowing you to invest in REITs with just a few clicks. Remember, it's essential to do your homework before investing. Look at a REIT's performance history, its sector, and the stability of its dividends. Keep in mind that investing always involves risks, and REITs are no exception. However, with potential high dividends and the chance to invest in real estate without the need for a huge capital outlay, it might be a risk worth taking. Investing in REITs might seem daunting at first, but with the right guidance, it can be a smooth process. Not all companies involved in real estate qualify as REITs. So what makes a company a REIT? To qualify as a real estate investment trust, a company must meet certain strict requirements. First, the company needs to be structured as a corporation, trust, or association. It must be managed by a board of directors or trustees. Second, the company must have at least 100 shareholders. No 5 individuals can own more than 50% of the shares. Third, the company must invest at least 75% of its total assets in real estate, cash, or U.S. treasuries. Further, it needs to derive at least 75% of its gross income from rents, interest on mortgages that finance real property, or from sales of real estate. Lastly, the company must distribute at least 90% of its taxable income to shareholders annually in the form of dividends. With these standards in place, investors can trust that they're investing in a genuine REIT. Like other investment options, REITs come in various types. Let's explore a few of them. First off, we have equity REITs. These trusts invest in and own properties, and their revenue comes mainly from their properties' rents. Blackstone Real Estate Income Trust is a prime example of an equity REIT. Next, we have mortgage REITs. Unlike equity REITs, these trusts deal with investment and ownership of property mortgages. They earn income from the interest on their mortgage loans. Finally, we have hybrid REITs, which combine the investment strategies of equity and mortgage REITs. They own both properties and mortgages. Simon Property Group is a well-known hybrid REIT. Each type of REIT operates differently and carries its own set of risks and rewards. So, it's crucial to understand the nature of these types before diving into investment. Understanding these types can help you make an informed investment decision. Just like any other investment, REITs have their pros and cons. Let's dive into the advantages first. One of the most attractive features of REITs is the potential for high dividend yield. Unlike traditional stocks and bonds, REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This makes them a great option for income-focused investors. Another advantage of REITs is diversification. Investing in REITs allows you to gain exposure to the real estate market without the need to buy, manage, or finance properties yourself. You can have a slice of different types of properties, from commercial spaces to residential estates, all under one investment umbrella. Furthermore, REITs are highly liquid assets. Unlike physical real estate, which can take months to sell, REIT shares can be bought and sold on major exchanges with ease, much like regular stocks. But, as the old adage goes, there's no such thing as a free lunch. While REITs come with these enticing benefits, they also carry certain risks. One of such risks is market volatility. REITs are subject to the same market risks as other stocks. If the stock market takes a tumble, the value of a REIT can drop alongside it. Interest rate risk is another concern. When interest rates rise, the cost of borrowing increases, which can negatively impact the profitability of REITs. This can lead to a decrease in the REIT share price and the potential reduction in dividends. Lastly, REITs are not immune to the risks inherent in the real estate market. Changes in property values, shifts in demand for certain types of properties, and fluctuations in rental income can all impact the performance of a REIT. Weighing these pros and cons can help you decide if REITs are a good fit for your investment portfolio. So, it's crucial to do your homework and understand the ins and outs of REITs before diving in. One of the attractive features of REITs is their dividends. You see, real estate investment trusts are not just about buying and selling properties. They offer a steady stream of income too. How so? Well, by law, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. Yes, you heard it right, a whopping 90%. Let's put this in perspective. Suppose a REIT earns $100 in taxable income. It must distribute at least $90 back to its shareholders. This leaves just $10 for the REIT to reinvest in its business or hold onto for future endeavors. This distribution requirement is what sets REITs apart from other types of investment vehicles. It's also what provides a consistent and often substantial income for REIT investors. So, while the value of the REIT's properties may fluctuate, the income from dividends remains relatively stable. These consistent dividends make REITs an appealing choice for income-focused investors. Now let's talk about a special type of REIT, the paperclip REIT. This isn't your ordinary office supply. In the world of real estate, a paperclip REIT refers to a unique blend that combines the features of traditional REITs with additional services. Imagine a traditional REIT as a paperclip. It's straightforward. It holds your investments together. Now imagine adding a few extras to that paperclip. Maybe it's a ruler, a bottle opener, or a mini flashlight. That's what a paperclip REIT does. It holds your investments, but it also brings extra features to the table, like property management services or real estate development. This type of REIT provides the opportunity for investors to gain exposure to real estate markets while benefiting from extra services that can potentially enhance returns. It's like having an upgraded paperclip for your investment portfolio. Paperclip REITs offer a unique twist on the traditional REIT model. Before we wrap up, let's look at one more benefit of REITs, their tax advantages. Real estate investment trusts, or REITs, have some unique tax benefits that make them attractive to investors. For starters, REITs are required by law to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This requirement allows REITs to avoid corporate income tax, passing the tax obligation to the shareholders instead. But what does this mean for you as an investor? Well, this structure can lead to higher dividend yields compared to other investment vehicles. However, these dividends are generally taxed as ordinary income, not at the lower capital gains rate. This might sound like a downside, but remember, dividends are only taxed when they're paid out. If you opt for a dividend reinvestment plan, you can defer paying taxes on those dividends until you sell your shares. These tax advantages add to the appeal of REITs for many investors. So, there you have it. A comprehensive look at real estate investment trusts. We've delved into the intricate world of REITs, from understanding what qualifies as a REIT, the different types available, to how you can invest in them. We've also shed light on the pros and cons of investing in REITs, the dividends you can expect, and the tax advantages they present. And let's not forget the intriguing concept of pay-per-clip REITs. Remember, like any investment, understanding the landscape is key before diving in. REITs can be a great addition to your portfolio, offering diversification and potential income through dividends. But always do your homework and consider your financial goals and risk tolerance. Thank you for joining us today in the Wealth Boardroom. If you found this video helpful, don't forget to subscribe to our channel for more insightful investment tips. Until next time, this is Doc signing off.